Three, two, one. We're on the air. M. Solomon here. Expert.witness at live.com. Welcome. We have another presentation to share with you, and I think today's probably will be the most poignant of all the presentations we have done to date. I say that for a number of reasons. Most importantly, or most particularly, because we're going to try to summarize everything we've been sharing with you. Now, consider. Good golfer, good family man, good father, good patriot, great student in college. Don't look for my picture to show up in any of those categories. 30 years investment banking, 30 years mortgage banking, 30 years wholesale mortgage banking. Some of the greatest mentors you could imagine. John Anderson, UCLA Graduate School of Management, Anderson School of Management, was a mentor. Partners with Carl Icahn, met with Mario Gabelli and many others. I know what I'm doing. I've been doing it for a long, long time. I've met hairdressers, and I've met dentists, and I've met plumbers, and I've met mathematicians. I met a lot of educated and not so educated people that are a lot smarter than me. But they don't understand the mortgage business. And unless you've spent 10 years in the business, unless you spend at least 10 years in the business, not as a broker, but on the inside as a banker, you'll never know the tricks of the trade, the gimmicks, the schemes, the artifice, the things that are done to allow these guys to profit. I jumped over. I came to the other side, came to not be an advocate, but to just testify in these cases and to share with people what I believe are the fundamental problems with these foreclosures and why these foreclosures are, in essence, highly profitable, but highly unethical and borderline unlawful, but at the same time legal. So let's get started here. I want to start with, if I could, it comes with age, glasses, what can I tell you? As you can see here, number one, I want to share with you the trusts were formed by banks, member banks, bank officers and directors, and it was for the purpose of moving their non-performing assets, the liabilities of these bank officers and directors off balance sheet. If you want to be an officer and a director of a bank, be aware right now that you're going to have to personally guarantee that bank's liabilities. And that's where banks found themselves at the beginning of the Y2K millennium. They were the guarantor for these bank toxic assets. So to move these assets off balance sheet, they put these toxic assets, bank officer and director liabilities, into pools, securitized them. Securitized, what does that mean? They registered them as private placements. These are registrations. They then took those certificates and they funded your escrow with these toxic certificates. Let me say it again. Your escrow funded with these toxic certificates. And that means, or that begs the question, where did the wire into escrow go? Okay, I'm going to say it again. Where did the wire into escrow go? I believe it went into the pockets and the coffers of the United States government under the Honorable George Bush, and that was to satisfy the fact that nobody was willing to go and chip in on the world contribution to the war that was waged in Iraq and later in Afghanistan, also for homeland security, and as late as Obama's administration for the cost of Obamacare. So the wire never made it into escrow. The existing lien holder that you paid off, existing lien holder, was not paid off. It was given these toxic certificates instead. That begs the question of who's foreclosing on you. So the wire of cash into the closing agent paid to the existing lien holder went elsewhere. The demand for payoff issuer was given these certificates and carried back the existing lien of record that you paid off. That's not good. This made the existing lien holder, who you paid off, the seller's debt. That made the seller's debt your debt. It made the seller, in this case, the seller, and that's the existing lien holder, and that made the note holder the buyer. So the existing lien holder is the seller. The note holder is the buyer. What does that make you? It makes you a tenant. Let's take a break and move to the next screen. So these transactions are known as installment sales by way of a sale-leaseback arrangement. 7. where in equity in law, the consumer household is a transferor to a nominee. Of course, that would be MERS. 8. Whereas the nominee irrevocably granted and conveyed title into trust on your behalf to a third party as a fiduciary, meaning trustee. It's all redundant. 9. Whereas title is held in trust free of all liens and encumbrances on one condition, and that's 10. Title is held subject to the existing liens of record, whereas you paid off the existing lien of record at closing. So let's consider the following. Therefore, in equity and law, you are a tenant. You are the right of reversion or repurchase rights, whereas you are given credit for the term they call free rent, equal to the wire that was converted into an interest-bearing principal account. 13. So that at the term's expiration, the scheme triggers the reversionary interest and your right of repurchase. 14. In most instances, the repurchase price is your price to buy back your home, valued at a nominal amount, which is normally $10. 15. The reversion, however, is condition precedent to satisfying the federal withholding requirements on the cash wired into deposit. So in summary, the federal withholding taxes are due and payable at the culmination of the transaction, or what they call the year of disposition. 17. The amount owed the IRS is due by you as a partnership liability, payable by you as a member of a pass-through investment. You didn't know that. These rules and regulations are found in the IRC under the cancellation of debt by involuntary conversion, installment sale method of accounting, and series of tax-deferred like-kind exchanges. 19. In conclusion, your rights and entitlements as a reversionary interest come with one substantive caveat. Pay close attention, folks. Caution. That is where fraud repudiates all the creditor's claims, as a reversionary interest is always the creditor. So let's take a look at what we have here in a foreclosure. The plaintiff's attorneys filing foreclosure generally represent an accrued receivable, a successor by mergers and acquisition. Accrual is where, how do you explain this? In a straight note, the interest calculates as a per diem, and it's added every day without any payment being made until the end of a certain term, when it's all due and payable, principal and interest. So party S in our example is a seller. That'd be the existing lien holder. To party B, who's the note holder, the buyer, under a land sale contract, also called an all-inclusive trust deed, whereby the buyer is also represented by a vendor as a servicing entity. What that means is the seller is carrying back your equity in a sale to the buyer, who's the note holder, whereas the servicing provider is a paying agent for a foreign national investment banking entity. And a paying agent is responsible for federal withholding taxes owed to the IRS for COD income. That's from cancellation of debt and involuntary conversion.